Hey everybody, Kevin and Rick here from PaperStack, and we are in video 2 reviewing the mid-year report. And just in case you missed the first one, how do you find this mid-year report? Well, just go visit the PaperStack website, paperstack.com. Scroll all the way down to the bottom on the lower right-hand corner. You'll find the PaperStack 2019 mid-year market report. And this report has had a ton of views, but we've also had a lot of questions about it. And the question is what does that mean? So we've got some very interesting numbers on this. And in video 1, we talked about average investment to value. In this one, we're going to talk about another yardstick for investors, probably a more important one here, which is average investment to value ratio. And in my mind, this is the one that always is your main risk calibrator, because the more you're into a deal, obviously the higher risk that you're taking on. So you have to measure those out. And we've got some numbers here for first position and second position. And I think, once again, why don't we start with first position numbers here, Rick?
Yeah, 63%. And, touching on that, you hit the nail on the head. Risk meter. It's like, how do you calibrate your risk? And this is sort of the, if there was a red, yellow, green risk meter, this would be it. Everybody, you got to look at the investment to value, because at the end of the day, your asset's backed up by, it's backed up by real estate. 63% of the value on a performing loan. That, my friend, that makes my eyes pop out of my head. Yeah. I mean, if it's performing and you're buying it at 63% of the value, how much of a security blanket do you have there if they stop paying?
Yeah, that really is. In today's market, I mean, that's outstanding. And once again, everybody, these are assets that have traded on this platform, bought and sold. So they tally them all up, and 63% on a performing note in today's world, when, again, you've got properties that have increased in value nationwide. So this 63% it makes your margin that much safer. And when you can get good, solid yields, even double-digit yields on performing notes where you're in it for 63%, I mean, think about it. The market would have to take a huge dip before somebody's even heard on this, right?
Yeah, for sure. I mean, I think one of the things is the market has been running. So with the real estate market strengthening, you're going to see that number improve. It's great to see 63%. When you tie that into the 77% of the balance, it's like, man, you have a super secure investment. In my mind, I look at that for me when I'm investing, and I'm like, that is something I feel very safe investing. If they stop paying, I know that I'm protected, and I can go in, I can get that asset, and I can have a lot of margin on the back end. So that's great, And then
once again, various trade shows that you and I have been to, and talking with other bigger investors. I mean, there's people who are like, "Oh man, I got one at 80%," and they were pumped up about that, on performing notes, and those are out there. But again, there's always, where's that market demand, and when you have a platform like this, it's active investors who are looking to buy and looking to sell. So I think you're going to find reasonable, but this is, that's outstanding. And then, boy, you take just a move over to the next number there, 36% on non-performers. I mean, those are numbers that we saw 8-9 years ago, right? And again, everybody thought 4 or 5 years ago, the days of the big discounts are gone. Clearly, this disproves that.
Yeah, definitely. 36% it's another one that kind of makes you stop and just shake your head and be like, man, the market is alive. It's well. And, sometimes people forget, at the end of the day, when the market's strong, there's still 3% default rate. There's still $280 billion in non-performing debt. I mean, there's a market for that. The great thing about PaperStack is it's really providing an outlet for players in the game who normally wouldn't be able to sell to the retail market. PaperStack's allowing our users to sort of reach out and touch that tier 2, tier 1 type of fund, and able to liquidate assets into the retail market. So, I mean, that number is indicative of that 36%. They're getting the bigger discount. The higher up the food chain, PaperStack's opening up that waterfall.
Mm-hmm. Yeah, it clearly shows that, in addition to these numbers, but the market has really changed. Banks are not going to go back to doing what they used to do, which is foreclosing on everything and taking it back. We don't have obviously nearly, not even close to what we had in foreclosures before, but yet the system has stayed in place. In other words, instead of banks foreclosing, they stopped that. They started selling more paper than foreclosures. There's still always, as you mentioned, going to be a foreclosure rate, but they're not going to go back to the old system. Why? It doesn't make sense. It's so much easier for these banks, and you were talking about tiers, it's so much easier for these banks and the government entities to just sell these things through monthly auction. Fannie Mae and Freddie Mac have had huge auctions. We were looking at some in the office the other day. So this trickle down is going to be there. This is the best way really to acquire real estate. And why pay 80 cents at a foreclosure sale when you can buy a non-performing note and get 36%? I mean, it's a new market.
It does make sense. And I think what's going to happen is we've sort of had the early adopters of the mortgage note space over the past 8 to 10 years have sort of come into it. I think you're going to start to see potentially some of the real estate investors, if this report gets out and they're paying 80%, I mean, how can you not look to move to where the margins are better, right?
Right. Yeah, and these are realistic of where things, again, there's always going to be outliers and deals a deal, but these numbers based on a good volume, I think it does. It makes investors you have to stop and think and look at that and go, I need to look here. You know, this is a better place to be. This is where not only paper stack, but the market. It's, well, as you know, the book that I came out with, it combines real estate with real estate notes. And I think that's where the market is.
Yeah, I definitely agree with you. It's no longer can you just have the one discipline. You have to have multiple, sort of tools in your tool belt to start navigating this real estate market or navigating the investment market, and being able to combine just real estate and then real estate notes. It really makes you a more well-rounded investor, and it really sets you up for success in the future. Great book, by the way. I enjoyed it.
Thank you very much.
Yep.
Looking at these numbers on the previous video, we talked about investment to UPB on seconds, which were shocking. But these numbers to me, I mean, I almost had to go back. Are you guys sure? Did you check that out on second position loans? 9% investment to value ratio and 5% investment to value ratio. Boy, that makes those more worthwhile looking into, right?
Yeah, I did the same thing when we kind of washed out the numbers. I go, we need to go check our arithmetic here. I don't know that this is right, and we looked at it like, wow, that is, it's astounding. Sometimes when you're in the battle, you're in the trenches, you can't see the trees for the forest, and when you can back it out to 10,000 feet and kind of look at things, you're like, holy cow, maybe we should start looking at these seconds. I mean, 9% of value, that's pretty good. And when you start, combining, there's also a second piece of that puzzle that you need to look at is, the first position, where are they in the equation? But still, these are huge discounts on the second position loans. And, it's indicative that we're starting to see, sort of an uptick in people buying them.
Yeah, it makes sense. I mean, I'm going to combine a couple of numbers here because they're on the screen there. So if we're looking at non-performing seconds and you can buy it at 33% of the UPB and you're only in it for 5% of the whole value of the property, you can settle that thing for 50, 60 cents on the dollar and your returns are going to be ridiculous. And you've had safety within that investment the entire way.
That's it. It's all about the workout. It's all about what different strategies do you have. Not every one you're going to buy is like, look, I'm buying this to turn it performing, or I'm buying it to foreclose. When we actually attended your class 8 years ago, that's one of the first things we learned is like the power of that. Like, hey, let's settle this for 50 or 60 cents on the dollar. I'm in it at 33 cents on the dollar. There's a huge margin there. And then it becomes, I love that model because it's a velocity model. Mm-hmm. You can start turning and burning capital real quickly, because a lot of times when people, they have that opportunity to settle something at such a large discount, nobody wants to miss a deal, and they take it and they go, and you're in and out really quickly. So those are that's a good insight, Kevin.
Yeah. And you know what, when you wrap it in the big picture, the economy is doing well. A lot of these problems were a result of job loss and other issues, income losses. Maybe they went from full-time to part-time, whatever, and all the other things that can happen in life. But now with people working, making money, the economy's doing better, people don't want this debt hanging over their heads. So imagine somebody who ran into some difficulties. They've been able to make payments on the first. They haven't made it on the second, but they would love to pay that thing off. And again, we have to remember as investors, a lot of these folks haven't heard from that loan holder in years, right? I mean, it's just been in the system, and now it's up here. You get an opportunity and you close it out. People, you're right, I think are looking for a bargain, saying, hey, our house is appreciating again now. Let's pay this thing off. And if we can do it at 50 cents of the dollar, they win, you win on a good investment return. So those are absolutely worth looking into. For those who are not investing in those, for those already investing, you're probably telling us to don't tell everybody. Quiet. You're doing great. Yeah, zip it.
Yeah.
So worth looking at there. So again, look at these numbers. The first one is investment to UPB. That's one yardstick that people use at how much you're in that loan. This one is an average investment to value ratio, which is your risk factor on there. And I think when you look at just those two numbers, that's compelling a reason as a number enough for, if you're not investing in notes yet, you have to. It's the new way to acquire real estate, the new way to acquire cash flow without having tenants in place. And when you can do this safely at these prices, it shows you that this market is here to stay, that the system in place that the banks have and the government entities, they're going to continue to feed the note side because it's easier for them. So it's more efficient. It's cheaper for them to do. The big companies don't want to mess with the smaller price band, which is what we're going to talk about next. Do you need hundreds of thousands of dollars to get started in the note business? No, because the best deals for individual investors are going to be in the lower price bands, and you guys had some pretty impressive numbers on that as well. So we will see you once again on the next video.